Hello and assalamu alaikum everyone. So today we are starting off uh, with mainly starting off with starting explaining all the sources of finance, like in the first chapters where we have encountered some sources of finance, and I told you all to just hold off to those explanations. And in this chapter in particular, we have talked about the difficulties of getting finance, raising finance for particularly for new businesses, and we also talked about the distinction between the types of finance like internal or external, short term or long term. So now we're going to talk in detail about each of these sources of finance, starting off with the basics of internal sources of finance. Now, without further ado, let's begin. The first internal source of finance that we have is basically our retained earnings, or you can say your profits. Profits left after all deductions, including payment of taxation and dividends, have been made. Like, retained earnings basically can be defined as the profits that are left after all deductions, including payment of taxation and dividends, have been made. So after you deduct all of these from your retained earnings, from your profits, then what is left is called your retained earnings, and it is not distributed to shareholders. Just to remind you that, okay, since it has the dividends have been paid, after dividends have been paid, then what the profit is left, that is what you call your retained earnings. It is used as a source of internal finance. It can be generally reinvested in the business for future finance. That is, it's a significant source of finance for internal growth. So basically, most small businesses use this, small businesses and even some large firms as well, but particularly unincorporated businesses or private limited companies use retained earnings for for financing their growth, as it allows them to have slow and steady internal growth. Okay, so what are the benefits and drawbacks of using retained earnings? It is a self-generated source of finance. That is, it does not carry the cost of external financing, unlike loans. So if it doesn't have any cost attached to it, it's just a source of finance. Like, you don't have to just pay for something after using this source of finance. Like loans, you have to repay the loans with a rate of interest, etc. But in retained earnings, you don't have to do that, and it does not affect the gearing ratio harmfully. Gearing ratios generally in A2 term, but what this basically means is that there are no debts incurred, as the business avoids paying interest on a loan, and this can avoid heavy interest charges if the loan required is a large one. So instead of using loans, you can use retained earnings, and hence you don't have to pay for heavy interest charges. And it also avoids the necessity for secured loans and risk to a company's assets. So we're going to talk about the difference between secured and unsecured loans later in the next lecture, about when we talked about loans. But yeah, you don't have to pay for there's no risk to a company's assets. That when you go for taking loan, you can have secured loans by offering collateral, that is, by offering assets. So in case you are not unable to pay your loan back, then the business will sell your asset and get the money that they wanted. So it avoids that risk to the business. So you don't have to go for secured loans, you can just use a retained earnings, and it gives business flexibility in deciding how much of retained earnings to use. Like, they can use it whenever they want and how much they want. It is readily available for speedy investment, so you don't have to like have an agreement with banks, etc., or like issue your shares to, you have to sign documents and etc. for issuing shares. No, it's directly available for speedy investment. That is because it's your profit. Furthermore, using this source of finance may avoid the need for a company to sell further shares, enabling existing shareholders to retain control if they continue to hold a majority of the shares. So you don't have to sell your shares, and your existing shareholders basically retain your control, and the value of the shares is not diluted as well. So however, it has some drawbacks as well, that it can have substantial opportunity costs. That means that it could have been used elsewhere, like purchasing more assets, fixed assets, or some other, or invest in somewhere, some other places. You don't have to necessarily use it as a source of finance for some small purposes like your internal, for small things. Like, you don't have to generally use it as source of finance, you can just use it for investment as well. It causes conflicts with shareholders, as they are likely to receive lower dividend as a result of increasing retained profit. So it's not generally easy for large companies like public limited companies to use retained earnings, to have high retained earnings, because of the shareholder conflict that take place. Shareholders generally disagree with the idea of having higher retained earnings because they want the reward of the risk that they have taken in investment in the business. Like, they're not satisfied with lower dividends. When we, as we said, that retained earnings are profits left after all deductions, including the dividends. So if you pay lower dividends to your shareholders, you will have a higher retained earnings, but that's what the shareholders don't want. They want a higher dividend. So that's why your shareholder dissatisfaction might be there, or perhaps you can have, or if you want to satisfy your shareholders, you will have lower retained profits, retained earnings as well. So it is only available to business that are generating a profit. So in case your business is not a profitable one, you are already in loss and you need source of finance to cover up that loss, sorry, you can't use retained earnings. You have to go for loans or overdrafts or some other sources of finance. The retained earnings may not be sufficient for business needs such as purchasing expensive assets. So not all business needs can be satisfied with retained earnings because it might not be too much high, it might be a low amount. So you can't purchase expensive assets if your retained profits are not too high. Now you might have noticed that I am saying retained profits and retained earnings simultaneous. So both of them are like the same terms. They can be used interchangeably, but before this new syllabus in 2016, before 2016, these were referred as retained profits, but after that these are referred as retained earnings. So you have to use the term retained earnings, but you can use them interchangeably as well, just for good understanding. Moving on, the next source of finance is our reductions in working capital. When businesses increase stock levels or sell goods on credit to customers, they use a source of finance, that is your working capital. You are increasing your stock levels, that is you are increasing your current assets. So you are increasing you are using up your working capital. You are selling goods on credit to customers, you are prolonging that credit term. Okay, so that is also like you're using up your working capital. When companies reduce these assets by reducing their working capital, capital is released, which acts as a source of finance for other uses. So if you just reduce these assets, you can use this working capital elsewhere for some other purposes. That is like, if you reduce your current assets, that is you reduce your current assets, that means you can have that, you will reduce your working capital, but the capital that was used for purchasing these assets, that could be used somewhere else. Okay, that's what the basic idea is when we say reductions in working capital. If a business current assets exceeds its current liabilities on a regular basis, it provides the business with a potential source of finance. However, it is only available on short-term basis. When we say that the current assets exceed its current liabilities, that means that okay, your current assets are exceeding your current liabilities, so you can just reduce your current assets by reducing your inventories, not purchasing enough inventories, or like selling these assets, so that your working capital will be reduced, but that money that you have, it will be used as a source of finance, that cash. However, it is only available on short-term basis because you can't just regularly cut off your assets, because it is going to reduce your working capital, and reducing your working capital is only good up to a certain level. It is only possible up to a certain level. After that, it will be riskier, because that means you won't be able to pay off your short-term debts. That is certain in this point over here, that there are risks in cutting down on working capital. Cutting back on current assets by selling inventories or reducing debts owed to the business may reduce the firm's liquidity, that is its ability to pay short-term debts, to risky levels. So yeah, it's not too much good of a thing. It can be available sometimes when you don't have enough sources of finance, internal sources of finance. So it could be used in some instances, but not regularly, because if you use it regularly, then you won't have enough to pay for your short-term expenses. Moving on, we have internal source of finance, that is your sale of assets. When we say sale of assets, it doesn't necessarily mean that your assets are not in use, that is idle assets. Sometimes you might see this referred to as sale of idle assets. No, that in itself, when we say sale of assets, it's classified into two categories, like either you sell your idle assets, or you sell the assets that you do need. It doesn't mean that you don't need that asset. Okay, you need that asset, but you can still sell it and lease it back, that is sale and lease back. So sale of assets is basically categorized into two parts, that is selling your idle assets, or selling your assets that you will use, that you want to use, but you can sell it and lease it back, or sale and lease back, that is. So let's read this. A business can raise cash by selling assets that they no longer require, usually non-current assets. So your idle asset that you don't require or that are not coming in use, you can just sell them. And the benefits of selling assets is that there's no interest payment that need to be paid like loans, nor is there the risk of dilution of shares. So similar to retained profits, you don't have to pay off your loan, pay repayments on loans, and there's no risk of dilution of shares. And another point it has over the retained profits is that even if your business is not profitable, if it's not making profits, you can still sell your assets, okay, to get your cash. However, the business will lose the ownership of assets and cannot use it. So yeah, that's of course it has to happen if you're selling your assets. But so if you want to use your assets, if you don't have enough idle assets, but you want to raise finance with this method, you can do is you can sell and lease back. A business can sell its assets to a leasing company and lease it back to use the asset for a limited period of time by paying rentals at a lower price. So basically, you just sell your asset to a company, leasing company, that is, and you lease it back. Leasing it in itself is a source of finance, but in this particular case, we're talking about selling assets and then leasing it back, not normal leasing. So in this way, business can have a high cash inflow by selling the asset. Okay, you sell the asset, you get the amount of that, and that big amount you can just distribute it evenly in your cash flow forecast, cash flow statement. Like you get the high amount in 1 month, but you are using up only small payments of that in 1 month. Okay, in the first month you use 25% of that, and the second month you use 25% of that, and then third one 25%, and so on until it runs out that that payment is used as small cash outflows. You have a high inflow in 1 month, but you're using it as small cash outflows per month by paying rentals for leasing, which are spread over the cash flow statement, thus having a positive cash flow. So if you're still confused about this, okay, you get a good amount. Let's say, use an example, you have $100 by selling that asset, okay, which can be divided. You get that in 1 month when you sell that asset, but you still want to use that asset. So instead of just selling it, you lease it back. Okay, you lease this back, and for each month you just have to pay, let's say, $10. Okay, $10 per month. So you just sell that asset for $100, and per month you have to just pay $10 for leasing. And of course, you don't have to just use that money for leasing. You could use it for some other purposes as well. That means you have the money, you can use it for some other purposes, and you can also use it for getting your asset back. Okay, so I hope you get the idea that this was one when you just sell assets. Okay, sorry, my writing is a bit not so good over here because it's not really writing it using cursor on laptop for that. And then over here it's about leasing. Okay, hope you can read that. If you can't, I'm just dictating it. Okay, so here's the idea that you sell it assets at $100 per in 1 month only, and then that is your cash inflow $100, and per month there's a cash outflow of $10. That is very small compared to that, and doesn't mean that you have to use it for 10 months. You can use that assets for just 5 months, and you will eventually have $50, and that other $50, the remainder, you could use it for some other purposes. Okay, not necessarily for just using your assets. So that's how it becomes a source of finance for you. So we've talked about you can just sell your idle assets, or if you have some asset that you still need but you are in dire need of finance, you can just sell and lease back as well. So that's how these internal sources of finance work. Thanks for watching, and Allah Hafiz.